Hello and welcome to today's webinar. I'm Rachel and I'll be your moderator for today's webinar. So before we get started, I hope everyone is doing well and staying healthy. We are excited to have attendees from all over the world, so please take a moment to introduce yourself and let us know where you are joining us from, whether it's city, state, or any part of the world. You are most welcome to my CPE webinars. All right, let's see who all are joining us today. Your responses are truly appreciated. Before we dive in, please take a moment to check if audio and video are working properly. You should be able to see the screen and hear me clearly. If you run into any technical difficulties, please feel free to let us know in chat or questions panel or reach out to us at support@my-cpe.com. Well, this is an interactive webinar, so feel free to share any questions you have in questions panel. We'll try our best to address them at the end of the webinar if time permits. Just a quick reminder to comply with regulations. You must stay logged into the webinar until the end and answer all the polling questions. You will receive evaluation form within next 24 hours after the completion of this webinar. Thank you all for being here today. Now let's dive right in and meet our presenter. I'm thrilled to introduce you to Henry. He is the managing partner helping individuals, CPAs, attorneys, and advisors understand and manage life insurance portfolios. Many policies are expiring earlier than expected due to declining interest rate and premium shortfalls. Henry educates clients on these risks and provides strategies to ensure coverage remains effective. He also highlights life insurance as an asset class, offering both living benefits and traditional death benefits for financial security. So let's hear more from our presenter about himself and his presentation. Thank you again, Henry, for being with us today. And without any further ado, the stage is all yours.
All right. Thank you very much, Rachel. As I said, or as Rachel mentioned, my name is Henry Montag, and I'd like to welcome each of you. I'd like to thank Saul for putting the webinar together. I'd like to thank Rachel for moderating it. My function as the managing partner of the Tully Center East is basically to identify and provide guidance to my clients, which are individuals, which are trustees, which are professionals, and which are basically professional trustees as well. My function today is to share some information on a topic that's very near to my heart, and I'm sure to many other people. Before we began webinars before COVID, we used to be in a room and there'd be whatever 30, 40 people. And if I were giving a talk on the subject of long-term care in the beginning, I'd basically just say, just by raise of hands, who knows somebody that is either receiving care at home or in an assisted living facility or in a skilled nursing facility. And invariably, without a doubt, there would always be roughly 3/4 of the people, if not more, who would be raising their hands. I'm not going to do that here because we kind of lose the effect. But I am going to say that this is a very, very important topic, and I'm glad to be sharing it with the attendees. So without further ado, let me move into the first slide, which is basically my agenda. What we'll be speaking about today is matching and selecting either the death benefit or the living benefit of a life insurance policy. We'll be talking about the history of long-term care insurance and the industry as a whole. Where does long-term care fit in? What does it cover? How does it work? How do you apply for coverage? How do you apply for benefits? What are the qualifications to apply for benefits? What are some of the current trends and issues in the industry for 2025 and going forward? We'll be focused on two topics in this presentation. One, we'll be speaking about the traditional form of long-term care. And secondly, we'll be talking about the combination. So there are two types of coverages available, and we'll be covering them both. What are the PPA, Pension Protection Act? What is this combo or linked or living benefits that you may have heard about? We'll also talk on the corporate tax credits and some of the benefits of long-term care, tax benefits and credits of long-term care, as well as the agent or broker's role and the underwriting process. So, death benefit or living benefit. Everyone's familiar with the traditional death benefits, providing family income, paying off debts, future estate tax liabilities, future income tax liabilities, with those of you familiar with the Secure Act. Uh, we also provide money for educational funds, for family income. We fund buy-sell agreements for business partners. And of course, we provide legacy gifts to the next generation. Everybody knows that. Those are the traditional death benefits in an insurance policy. Not many people are as familiar with the living benefits. And one of the living benefits that we're going to talk about is combining life insurance and long-term care. We'll be talking about how long-term care pays from the death benefit tax-free. So imagine that somebody buys a policy, making up a number, $500,000 policy, $1 million policy, and they pay 1 year of premium or they pay 1 month of premium. And all of a sudden they need some form of long-term care. Imagine paying 1 month of premium and then being able to collect from that $1 million death benefit to pay for long-term care costs. That's not a wish, that's a reality. That's called a combination or a linked plan, which we'll be speaking about a little bit more in a moment. But for the time being, I just want to focus in on the idea that long-term care costs can be paid from the death benefit of a life insurance policy, and the benefits come out income tax free. We'll also be talking about the tax free exchanges of life insurance from an annuity for long term care. Many people are holding trillions of dollars of annuities, and in an annuity, a dollar is worth a dollar. But with as a result of the Pension Protection Act, all of a sudden now an individual can take a $100,000 annuity and perhaps turn it into, as we'll see, a $400,000 or $500,000 tax-free benefit to be used to pay for long-term care. More about that in a few moments. Some of the other living benefits that we won't be talking about today are to be able to use life insurance to supplement retirement income with tax-advantaged payouts, and also the idea of being able to sell a policy as a life settlement. Again, living benefit, because with life settlement, the beneficiary doesn't receive the benefit, the insured receives the benefit. So, just to summarize this for a moment, when the life insurance policy benefits the insured, it's usually a death benefit. When it benefits the beneficiary, I'm sorry, let me say that again differently. When it benefits the insured, it's living benefit, not the beneficiary. Combination policies pay for long-term care from the death benefit tax-free, and they can avoid income taxes on gains in an annuity to pay for those long-term care costs. As I said, in the next program, we'll be talking about the other two topics of the living benefits. So, first pop-up question: what is considered a living benefit? Using proceeds of a policy to pay off a mortgage, using the cash value to pay for long-term care costs, or using the death benefit to pay for long-term care costs? Let me let you take a moment and just answer that. Okay, I think most of you are done. And the majority of you are using the fact that life insurance death benefit can be used to pay for long-term care, and that is the correct answer, not the cash value. The cash value in the first year is basically non-existent, but the death benefit is 100%. Okay, and moving on. So, point being is somebody always pays for long-term care insurance, either with their time or with their money. This is a short quote from a book that I co-authored several years ago. And it's important enough for everyone to just take a moment to read it. An unexpected illness resulting in an unreimbursed long-term care medical expense can have catastrophic effects on the personal and the financial lives of your or a client's family. Advanced directives, buy-sell agreements, and other risk management arrangements that people make or don't make while they're healthy will determine the quality of their and their family's future lives. Those that plan ahead will avoid having their family deal with the financial and legal issues on top of the medical and the emotional issues. And if you do that, you'll be avoiding a family crisis. Think about that. So, if you or your client is the type of an individual to obtain homeowners insurance, even when their house is paid up and there's no legal liability to have homeowners insurance, or if you maintain auto collision on a car, even when there's no loan on the car, no obligation. And by the way, in both those situations, the risk of a total loss of a home or a car is less than 2 to 4 or 5%. Then you're most likely to want to protect against an unexpected, unreimbursed long-term care expense where the odds are 70 to 80% of occurring by the age of 70 through 85, with a significantly higher after-tax loss exposure than a home or than a car. And that information comes, of course, from the National Institute on Aging 2023. So, word about long-term care today, just very briefly. Long-term care provides independence and privacy and dignity, very important items. Money is important, but it also provides for a care coordinator, basically an individual who provides the administrative duties that need to be done and provides the peace of mind of allowing an individual to care about a family member, not for them. Another important point to keep in mind is that advanced planning, as I mentioned, helps avoid a family crisis. Insurers will soon be using genetic testing to be able to help them determine whom to insure and whom not to insure. Group long-term care insurance is the fastest growing corporate, personal, and group benefit. As we'll find out in a little bit, employers can discriminate as to whom the corporation or entity can pay for long-term care insurance premiums, and in some cases can even take them on a deductible basis. At age 72, for a 36-month period of coverage, if an individual needs service at age 82, so from 72 to 82 over those 10 years, you'll get back in 8 months what you've paid in over a 10-year period. Economically, does it make sense? Yes, it does. It makes sense if you happen to be one of those unfortunate people who need long-term care. And there's new research on Alzheimer's that shows an even larger increased affliction of individuals over age 85. Right now, Alzheimer's is in the crosshair of many research facilities and individuals, and they're making headway. And in making headway, they're gaining more information. And the insurance companies are certainly going to begin using that information to limit whom they offer individual coverage to. Let's just take a look for a moment at what a traditional long-term care insurance coverage looks like. Benefits are available from $100. Keep in mind, there are two coverages that we're going to be talking about. One is the traditional, which I'm going to be covering now, and the second is the combination or linked. And we'll be talking about that in a few moments. So on traditional, benefits are from $100, $500 a day. The benefits used to be 3 years, 5 years, 6 years, 10 years, or a lifetime. Insurance industries found that it doesn't make sense to insure people for a lifetime because their exposure is too high. They don't even want to insure people for a 10-year period. That's why those two items are dubbed in red. But you can still purchase a policy with a 3-year, 5-year, in some cases, 6 years of coverage. There's a waiting period, just like a deductible on a car insurance. They don't pay from the first dollar. Well, I mean, they do if you want to have a 0-day deductible. But keep in mind that Medicare, which is a program that's available for individuals over age 65, will usually pay for the first 90 days or first 100 days. So you don't necessarily need a benefit to start from day one. I usually choose a 90-day waiting period. Inflation options, you might start out with $100 or $200 a day, but we certainly know that in 5 or 10 or 15 or 20 years, that $100 or $200 a day is not going to be sufficient. So the insurance industry puts in inflation options where you can have either 3% or 5% compounding or simple interest. How to qualify to purchase? Well, that goes through underwriting, and we'll be speaking about underwriting at the end in a separate slide. But you basically fill out an application and you submit it to the insurance company. The insurance company contacts your docs, and then they go ahead and will make a decision to issue a policy or not. They don't necessarily come and do a physical exam. It's not like life insurance. They get most of the information that they need directly from your doctors. How do you collect benefits? Well, there, again, a separate section on that. So I'll go over that in a few moments. The future outlook for long-term care, it's going to be limited only because as more and more people use this, the insurance industry is looking to continue to offer the product, but they're looking to make a profit at the same time. And some of those premiums on the traditional standalone plans can be fairly expensive. Premiums on the traditional standalone plans, as we'll find out in a few moments, are not guaranteed. The premiums can and do increase. The linked or the hybrid or the combo plans are all one and the same. Though that pricing is guaranteed, and many individuals, as you'll find out, are concerned about buying the traditional because they've seen prices increase dramatically. Group individual, yeah, individuals can be discriminated against in group policies. In other words, all presidents, all officers of a corporation can get coverage paid for by the corporation on a deductible basis. And the employer can discriminate and just say all presidents, all vice presidents, all officers are able to get this coverage, and the rank and file employees are not. Good for business owners, not so good for the rank and file. There are deductibility issues, and there are credits that are given as an incentive. A policy can either be a reimbursement where you need to provide bills, or an indemnity where all you have to do is say, I'm not able to do the two activities of daily living, eating, bathing, dressing, toileting, or transferring, or I have some sort of, even if I could do all that, but I have some sort of a cognitive impairment. Those are the triggers for an individual collecting benefits. The difference between a reimbursement where you need a bill and an indemnity is where you don't need a bill. I'm going to be speaking about this, as I say, from my own personal experience. If you look down the bottom left, in the fall of 1986, I gave my first speech on this topic to the New York State Society. I'm sorry, this was to the New York State Bar Association. And back then I called it Advising Clients on the Infirmities of Advanced Age. Back then, it was a small group of 60, 70 some odd attorneys in the room. And at the end of the session, 4 or 5 of the attorneys stayed and they said, Henry, you're onto something. But one of the individuals in particular said, but we can't call this Advising Clients on the Infirmities of Advanced Age. We're getting old just talking about the title. How about we call it elder care? That was when the term elder care first came about, fall of 1986. So I can tell you that there's a growing need of service. Today's society, pharmacology being what it is, we're basically converting a illness where people used to pass away from and turning it into a chronic illness. Age 80 is the fastest growing segment of the population. I look at things as a roulette wheel of illness, and many attorneys do as well. If somebody has a stroke, well, then Medicare will certainly go ahead and pay for all the medical care and all the needs of that individual client. But if the individual were to come down with a Parkinson's or some sort of multiple sclerosis or even Alzheimer's, wrong illness, Medicare will not pay anything for that. People basically have artificially impoverished themselves to go on Medicaid because various elder law attorneys developed various strategies in conjunction with long-term care. And they would say, don't take 100% of the risk, share a percentage of the risk with an insurance company. So years ago, there used to be a 24-month waiting period before someone could qualify for Medicaid. I'm not speaking of Medicare now, I'm speaking of Medicaid, which is an individual program for individuals that are impoverished, that don't have sufficient money to take care of themselves. And as you'd expect, time went on and Medicaid rather, sorry, and Medicaid raised its waiting period from 24 months to 36 months, currently to 5 years to 60 months. Government tried to solve the problem, but it's just too expensive. The providing care is in the trillions of dollars. So the next best thing came about, and that's something we'll call the Pension Protection Act. And we'll talk about that, as I say, in a few moments. What does long-term care cost? Well, here's an example for a male 62 and a female 58. If both partners provide an application at the same time, there could be anywhere from 15 to a 20% marital discount. If individuals are in good health, there is a preferred, their classifications are preferred or standard. Let's just assume somebody's picked a 200-day benefit period, that's $6,000 a month. And after a 90-day period, there was a 3-year period of coverage, and this particular individual this couple rather, had a 3% compound inflation option. This was a reimbursement, which is a little bit less expensive than the indemnity. If you'll recall, the reimbursement, you provide a bill, whereas with the indemnity, you don't. Yeah, it's not fair that a woman costs more than a man, but women live longer. And sometimes a man has a wife available to provide help and care. And since women live longer than men, sometimes the male will pass away, the husband will pass away, and the wife is alone. Where the wife was able to help provide care for the husband, that's no longer the case with a wife when there's no spouse available. So $2,900 for the male and approximately $3,700 for the female. In various states, there are state tax credits. In New York, it happens to be a 20% credit. So that's $6,710 less the 20% credit brings the cost down to approximately $5,300. By the way, that 20% credit is only valid if the adjusted gross income is under $250,000. So the insurance company had some issues. Back in the 80s, when long-term care insurance first came about, they didn't know how to price this. There was no long-term care pricing before, so they basically assumed, and they did one of these, let's see, we'll charge this much. They also had no idea how much utilization individuals would actually use. With life insurance, that less than 2% of term insurance ever gets paid out as a death benefit? People surrender the policies, people give up coverage. They thought that people would do the same thing with long-term care. Not the case. There's a very sticky substance to a long-term care policy because each and every year the costs increase. And as people's health changes, individuals may not be able to obtain coverage. So the sticky rate for long-term care insurance is basically 97%. Majority of people who buy a long-term care policy coverage stick with it. And many companies were out to say, we're number one. Won't mention names, but the companies that were looking to become number one because they provided the most coverage and the most care, and they got some credit for being the number one. Those are the companies that had the biggest problem because of all the problems that I just mentioned, the incorrect pricing assumptions or the incorrect surrender assumptions or the incorrect yield assumptions. In the 80s, if those of you who are around back then remember, interest rates were in the high teens. The actuaries assumed that those higher interest rates might stay in effect for many, many years to come. Well, as you know, we've gone from, with the exception of the last 2 years where interest rates have gone straight up, we've gone from interest rates in 1981, 21% was the top interest rate. So we've gone from 21% down to the current, well, forget current because, it's now 4 to 5%. But for many years, interest rates were down to the 3 to 2% ranges. So problem led to significant premium increases, which led to significant bad press, which led to consumer fear to purchase this long-term care insurance because they heard from their friends that had purchased it that there were 10, 20, 30% premium increases, and it led to a desire in the industry for guaranteed pricing. So, in my opinion, traditional long-term care insurance failed as a product. It was too expensive. The premium increases trend just basically gave way to fear. It was an uncomfortable topic to discuss to begin with. And of course, everybody's saying, hey, this won't happen to me. And even if it does, I'll self-insure. And what if I buy this stuff and what if I never need it? If I don't use it, I'm going to lose all that money that I paid in premium. Very similar to a car insurance or very similar to a homeowner's insurance on a home. But people never said, gee, shucks, I didn't have an accident all year and I wasted all that money on my car insurance. No, it's insurance, it's coverage. But it was certainly an excuse for people not to buy traditional long-term care insurance. It was easier to consult with an attorney and artificially impoverish oneself. Again, this doesn't work for everyone, but for those individuals who were able to give away their money and wait that 24-month or 36-month or 60-month waiting period, depending on when they did the planning, they were able to work with an attorney and artificially impoverish themselves. As a result, less than 12% of the market after 30 years has basically obtained traditional long-term care insurance. So when the industry was faced with all of these problems and having made the wrong assumptions, and the yields were not what they expected, incorrect pricing assumptions, incorrect usage, much greater than anticipated, and sustained reduced interest rates, the industry had no choice but significantly raise the rates on new as well as current insureds, because keep in mind, as I said, there were no guarantees. And it encouraged insureds to reduce existing coverage because eventually they just couldn't continue. And at one point, we used to have 18 to 20 individual long-term care insurance companies that offered traditional long-term care. Today, the number is basically less than three. And as far as I'm concerned, there may be two companies that are worthwhile. The third one is just they're keeping the coverage on the books, but they don't really want to sell it. So they've created significantly higher costs, and very few people respond to those costs. But the majority of new LTCI coverage today is offered through combination plans. So the solution to long-term care premiums rising 100, 150%, easing consumer concerns as to future rate hikes, reducing the insurer risk, and reducing the federal and state Medicaid expenditures by private government, and looking to increase private ownership of long-term care insurance, and to stop the typical, well, if I don't use it, I'll lose it, or I'll self-insure. The life insurance industry solution was combining life insurance and long-term care insurance and significant tax benefits. Along comes the Pension Protection Act, which was a collaborative effort by the government and insurers designed to providing one, the price guarantees against rate increases. Once you purchase a combo plan, that's it. Your health changes, interest rate changes. If you pick a guaranteed plan to start with, 10, 15, 20 years later, that premium increase is non-existent because the guarantees are against future rate increases. And it was also an effort to increase private ownership of long-term care insurance benefits. And it also gave the insurers an opportunity to return to profitability. And the government benefited by reducing government Medicaid costs. So for the first time, a hybrid linked or combo plan paid for long-term care expenses with a extra boost. Benefits were provided on a tax-free basis directly from the death benefit of the insurance company, directly from the death benefit of the insurance company. And the second option of the Pension Protection Act was that it allowed tax-free transfers from annuities to pay for long-term care costs. We'll cover that in a moment. So for the first time, linked combination plans, life insurance, death benefit, all 100% income tax-free. Example of how it worked. If somebody picked a $1 million policy, they would have the choice of a 2% payout for 50 months, which is basically $20,000 a month, or they could have chosen a 4% payout for 25 months, $40,000 a month, and all distributions are 100% income tax free. The majority of new policies today contain two types of riders. I'm not going to get into the weeds on this, but I'm just going to let you know that there are two types of riders. One offers a chronic care rider where there's no upfront cost, and the second offers a long-term care rider, which does have upfront costs. But for the time being, I'm just going to say that the long-term care riders, even though there's an upfront cost, they offer a better deal for the consumers. And if no funds are withdrawn to pay for an LTC claim during the individual's lifetime, well, then 100% of the death benefit goes to the beneficiaries. And again, as always, life insurance is 100% income tax free. So, second pop-up question. Proceeds from the death benefit used to pay for long-term care costs are 100% tax deductible. True or false? And I'm glad to see everyone's listening. And yes, both the death benefit as well as the long-term care benefit are income tax free, and basically 100% of you got that. Okay, so old saying, not everything that glitters is gold. So what's the trade-off? Well, there are trade-offs, and comparisons must be made on an individual basis. Every situation is different and depends on the individual's personal history, personal facts, and personal objectives. And although the idea of the combo plan is an attention grabber, price alone is not a sufficient indicator. There's nothing right or wrong about a traditional plan or a combination plan. The right type of policy depends on individuals' objectives. For a traditional plan, when there's no need for an inheritance and you don't have to worry about leaving a death benefit or leaving assets and you just want to take care of yourself, traditional plan works better than the combination plan. When the emphasis is on the insured, when tax credits are important, certain tax credits are only available on the traditional plan, not on the combination plan. When cost is a factor, it costs more to have the combination coverage, because with a combination coverage, the insurance company is going to pay out either during the insured's lifetime or at his death. With a traditional, that's not the case. If the individual pays premiums for 10, 15, 20, 30 years, and the individual, fortunately or unfortunately, passes away in their sleep one night, that individual is never going to be claimed to the insurance companies. And all of those premiums that have been paid are basically going right down to the insurance company's bottom line. Combo plan, when there's a need or a desire or a want or a desire for providing an inheritance, when the emphasis is on the beneficiaries, when guarantees are important and you don't want to be in a situation where the prices can increase, where there's a medical qualification issue, it might be easier to qualify for a combination plan rather than a traditional plan, because it all depends on the medical issues that the individual has. And basically, when the individual says, what if I never need it? and I'm not going to buy this because what if I never need it? Then two combination plans make sense because somebody will always collect the benefits. So distributions are made on premiums, and distributions can be made tax-free to pay for long-term care costs. If you look on the left side screen, you only used to be able to transfer life to life, annuity to annuity, and a life insurance to annuity. After the Pension Protection Act, the new 1035 tax-free exchange rules allowed an individual to transfer an annuity to life to long-term care, life insurance to long-term care, and qualified lifetime care to a long-term care policy. Using an annuity, if you just had a $100,000 policy or $100,000 annuity, the gains on that policy would be subject to taxes. Not the case with a long-term care rider. As we'll see in a moment, using a single premium deferred annuity, there's certain benefits, and some of those benefits are tax deferred accumulation, guaranteed interest rates, guaranteed settlement options for the beneficiary, and the distributions of gains are 100% taxable. It's a good vehicle to accumulate, but not a good vehicle to distribute. So, just an example. Somebody starts with on the left side, prior to the Pension Protection Act, somebody starts with a $500,000 annuity, and over a 20-year period, there's a gain of, let's just assume somebody can earn 5% compound, and after a 20-year period, there's $500,000 taxable gain, 40% tax rate, 200,000. What's available is $800,000 to be used to pay for long-term care costs. However, after the PPA, after the Pension Protection Act, there's a $500,000 initial annuity. The gain is $500,000, but now none of that gain is taxable. You've now got a full $1 million available. Plus, PPA allowed you to use part of that money to buy a LTCI rider, which provided approximately another $400,000. So you're looking at pre-Pension Protection Act, an $800,000 fund available as opposed to $1.4 million available. Maximizes a person's coverage, does a very good job of doing that. Example of what that 68-year-old male preferred non-tobacco user who starts out with a $100,000 premium turns into a $159,000 death benefit. But again, the individual is doing this not necessarily for the death benefit. They're doing this for the long-term care benefit. And you're able to take, using that annuity, $100,000 and turn it into almost $500,000 care benefit. So change gears for a moment from a single premium deferred annuity to a single premium immediate annuity. With a single premium immediate annuity, you wind up giving the insurance company X number of dollars, and in return, they guarantee to give you a certain predetermined tax-favored payout for the rest of your life, or for as long as you choose. It could be guaranteed for 5 years, guaranteed for 10 years, for 20 years. It could be guaranteed for as long as you choose. But when you use that single premium immediate annuity to pay for a long-term care premium, what was previously a partially tax-free benefit because of the exclusionary ratio, it now becomes 100% payout if it's used to pay for long-term care insurance premiums. The government is successfully trying to incentivize people to buy long-term care insurance instead of going on Medicaid. Various stories in the Wall Street Journal talking about this. This was the new strategy that everybody discussed. Okay, on the traditional, if we go down to the bottom, on the traditional tax benefits, There are two. As I mentioned earlier, there's a state tax credit. In New York, it's 20%. I know that we're dealing with people from all different states, so I would urge you to check your own state, excuse me, and see what the tax credit is in your particular state. Okay, so what's the most significant outcome of the PPA? Life insurance death benefit can be used to pay for long-term care. Death benefit distributions are income tax free when used to pay for long-term care costs. There are tax benefits available for annuities or all of the above. And I'm going to answer this one because everything that I just mentioned, those are all significant outcomes of the PPA. All of the above would have been the answer. So if you're involved in a corporation or any sort of a LLC, you're taxed as a C Corp, you've got the best of all worlds. It provides long-term care coverage to a discriminatory valid class of employees. It could be all supervisory personnel, it could be all officers, it could be all rank and file. It's whatever the owner of that C Corp decides. And the premium associated with that, if it's a qualified long-term care policy, is income tax deductible to the company as compensation under ISC section 162. The deduction applies to premium payments made on a policy that covers members of the valid class, and here's an interesting thought, also the members' spouses or dependents, IRC section 152. So if somebody chooses to provide coverage, long-term care coverage to all officers, it's not just the officers, but it's also the officers' spouses or other family members. S corps, not so good. And rather than reading through this, this is in your slides. I'm just going to skip over it and you could look at this on your own. Pass-through entities, again, just like the C Corp, you can deduct 100% of premiums paid for the individuals as well as the individual spouses, as well as their other eligible dependents. And that's without regard to the normal unreimbursed medical expenses that where you have to be in excess of 7.5% of your adjusted gross income. What's the agent or the broker's role? Well, to be able to explain not only the product options, but also to be able to explain all the available strategies and to assist the client on deciding on their particular objectives, to obtain the necessary data to match the client's objectives and to explain the underwriting process, and then to manage the administrative process and deliver the policy. For consumers, the benefits are to avoid future rate increases, to maintain the existing coverage, and to decide on either the traditional plan or combo plan. From the insurance point of view, the benefits were that they were able to increase premium. They suggest people decrease coverage. My suggestion to my clients and to you is don't lose what you already have because you'll never be able to replace it. So rather than taking their offers of reducing or decreasing coverage, don't take those offers. Try to perhaps reduce the benefits from a lifetime benefit to perhaps to a five. And there are certainly many people that have 10-year benefit periods, coverage periods, or lifetime coverage periods. Consider reducing part of that coverage from a lifetime to a 10-year, or from a 10-year to a 5-year. The average length of stay for individuals needing some sort of care, other than those needing care for Alzheimer's, is usually less than a 3-year period. So for the insurers, it's being able to return to market profitability. For the regulators, simple for an insurance company to say, if you don't give me this, to the regulators, if you don't give me this rate increase, I'm going to declare bankrupt. I'm going to go out of business. We're going to go insolvent, as some insurers have done. So rather than um, having the insurance companies face that situation, or um, being able to just walk away, uh, the regulators have given the insurance company the ability to control increasing premiums by offering various objectives, various abilities to manage that coverage. How to handle increases. Um, Not as significant a problem today as it was 10 years ago. The insurer will always offer ways to offset rate increases. As I said a moment ago, don't accept them as you'll never get back what you lost. If possible, pay the increase. In later years, consider dropping the inflation option. When my clients reach their 80s, I suggest that they drop the inflation option because that inflation option represents 50% of the cost of the coverage. And again, as I said earlier, consider dropping from a lifetime to a 10-year or a 10-year to a 5-year benefit period. What should the agent be doing? Well, you should be dealing with someone who's independent, someone who's able to go to the various appropriate companies and negotiate the best offer because it's all based on your medical history. What you don't want is someone who's new to the business or new to the field of long-term care insurance, because most cases that I deal with, I'm always not necessarily fighting, but I'm always sticking up for the client and using his or her medical history um, as reasons why the insurance company should provide coverage and why they should provide coverage perhaps on a standard basis rather than on a rated basis. As I said earlier, it's only a matter of time before genetic testing begins, and Alzheimer's screenings are already in place for individuals over age 75. All medical history and medications must be disclosed on an application. Insurance companies are pretty smart, and they're able to nowadays find out what, because again, during an application, you're giving the insurance company carte blanche uh, uh, right to go out and obtain your medical history. And there are now services that will tell an insurance company what medications, assuming that they're being paid for by some sort of a health insurer, will be able to tell you what medications. So if you're filling out that application and you're leaving off blood pressure medications or cholesterol medications or uh, some sort of psychotropics, and you figure that the insurance company is not going to really find out. Yes, they will find out. So the underwriter, as I say, is authorized to check your prescription refills, and they do. Um, the broker letter should help explain any problems. The broker letter should highlight favorable lifestyles. My insured belongs to a gym. My insured does 10 minutes of walking each and every day. My insured exercises. My insured joined a health club. My insured lost weight. Whatever it is, that should be written up in a underwriting letter. The insurance company will also set up a 20-minute telephone interview. Um, they're not going to necessarily see the individual unless they're over 75. And in many cases, many companies nowadays, the traditional companies over 75, they've stopped providing insurance. They don't need to. It's totally discriminatory on the face of the insurance companies. They don't necessarily have to provide everyone coverage. That's why insurance companies stay in business. They try to make good choices. If there's no medical issues, they'll issue a policy. If medical issues exist, the insurer will write to the doctors and they'll clarify any questions that they have. Once the information is obtained, the underwriter will approve a particular health class. It'll either be a preferred, or it'll be a standard, or there'll be some degrees of ratings. And best efforts must be made to negotiate and obtain the best offer for the client, because the client really doesn't have an opportunity to do that negotiation for himself or herself. That's up to the individual agent or broker. And I should say for a moment, some of you may be aware, but for those that aren't, let me just mention, a agent is usually an individual who works for one particular company. His or her um, expenses, office rental, secretary, health insurance, retirement benefits are usually paid for by that insurance company. In exchange, that insurance company expects that agent to place their business through that particular insurance company in exchange for all of those benefits. Whereas a broker is someone who's independent, pays their own expenses, doesn't have a insurance company who's telling them what to do, and is independent and is able to go to the best company for that particular individual insured. Summary of benefits: proceeds of long-term care insurance are now 100% income tax free. Life insurance can be converted to long-term care tax free. A SPIA, single premium immediate annuity, can be used to pay for long-term care premiums on a 100% tax-free basis, as opposed to previously, an individual would have to use 100% after-tax dollars to pay for their long-term care premiums. Now they can use dollars, and they can use those dollars that have grown income tax deferred, and they can now use them to pay a premium income tax free. 100% of untaxed gains on the annuity can now be used to pay for any sort of long-term care expense. 100% of untaxed gains on annuities can be used to pay for any long-term care expense. Hybrid plans, combo plans, is a better way to self-insure. Most new policies today offer a combination rider. As I mentioned, it's either a chronic care rider or it's a long-term care rider. Chronic care riders have no cost. Long-term care riders have a cost. You get what you pay for. It's no longer a use it or lose it with long-term care insurance. The combo plans allow the individual insured to use the benefit while they're alive if they need it. If not, 100% of that death benefit is available 100% income tax free for the beneficiaries. And you've got to compare similar costs for the traditional or for combo plans. I'm just going over the same information. What is the most significant? Very good. 100% of you answered all of the above. And with that, I hope that you gain some knowledge, gain some information. Several years ago, I was asked by the American Bar Association to write a book called The Advisors and Trustees Guide to Managing Risk. All the information that I just went over is highlighted in the book. If anyone's interested, there are discounts available for flyers. Additional resources, including myself, are available in the handouts. There are articles that were distributed. I suggest that you consider reading those two articles. One is from Accounting Today, the other is Bloomberg. Some very good information in there. Use me as a resource. Available to my CPE registrants to email me with any questions, call me with any questions. If you have a client, either for yourself or for a client, and you want some more information, pick up the phone. That's my agreement with my CPE. I'm available to not only provide this information over the course of an hour, but to act as a living resource for any questions that you might have on the topic. So that said, I'm going to thank you, and we just about ended on time, but I think we do have a couple of moments left for any questions. So Rachel, if there are any questions, please let me know or open up the chat box for any questions, and I'm available to answer them.
I'm sure we'll give few more minutes to our attendees to check if they have any other questions. Till now, we have not received any question.
Okay, again, most people save the questions until after the program, and then my emails light up. So that being the case, I will say thank you to the attendees Thank you, Rachel. Thank you, Saul, for setting this up. And for those of you that would like to take advantage of my offer to act as a resource, I'll look forward to hearing from you either later today or when the subject of long-term care comes up, and you might consider this for yourself, for a family member, or for a client. If there are no other questions, I'm going to say thank you and sign off. Rachel, if there are no other questions, we can go
Mhm.
ahead and close the webinar.
Okay, perfect. Thank you so much for joining us today for our webinar on my CPE. I hope you found this session informative. I'd like to extend a special thank you to our presenter, Steve. Sorry, our presenter, Henry, for sharing his expertise and insights with us. Henry has been one of our best presenters, and we are always thrilled to have him on our platform. Thank you again, Henry, for this amazing session.
Thank you, Rachel, and thank you to the attendees.
You're most welcome. One
Thank
more
you.
important thing, everyone, to get your credit certificate, you will receive an evaluation form within the next 24 hours after the completion of this webinar, provided you have answered all the polling questions. If you have any further questions or need to view the recording, please feel free to email us at support@my-cpe.com. Once again, thank you so much for being such a wonderful audience. We appreciate your participation and hope you'll join us again for our future webinars. Take care of yourself and your loved ones. Stay safe and stay healthy. Have a great day
Thank
ahead.
you.
Thank you.
Bye-bye. Thank you, Rachel. Bye-bye.
Bye bye.